there's no limit to the amount of money they can access and pull in from traditional markets. So we're going to see a different type of run that might be slower. It might be a slow grind, but I believe that ultimately this is the process of crypto going mainstream, crypto actually becoming a part of the global financial system. And it's only going to happen once. And I think for that reason, we're looking at probably the biggest cycle that we've ever seen.
I want to start off with this video clip from this gentleman here, Aleo Trades. He is the co-founder of Black Hole, which is the fastest growing decentralized exchange on Avalanche. And his perspectives, if you guys did not watch this, one of the researchers shared this in the chat the other day. I watched it all the way to the end and I reshared it in each of the chats yesterday because his perspectives align with exactly what we talk about here in this community, which is that we are no longer in this 4-year cyclical period anymore, especially now that institutions are onboarded. Instead, we are in this headline driven environment where if we do see market corrections, if we do see pullbacks, if we do see month long to 3 month long to 6 month long periods of pullbacks because of headline driven related risk off environments, buy the fuck out of those dips, right? Because what's coming over the next 2 to 3 years is going to be substantially more than what we've seen over the last 16. So I want to set the tone for today's video breakdown because this is aligned with everything that we've been discussing, not only in these fundamental calls, but just what I've been teaching you guys, especially around our DCA strategy, where we're not buying into the rallies. We're not buying when the market's up 50 to $100 billion, unless you're just trying to gain exposure to a blue chip asset that you think is going to outperform in the long run. But we're really focused on those intraday pullbacks when the market's risk off, when everything's down 50 to $100 billion and everybody else thinks we're headed into some bear cycle. We're getting in at those discounted prices to mitigate our downside exposure and maximize that upside return. So just listen here to what he says. It's about a 2 minute long clip, but he gives some really good detailistic perspectives as to what he thinks is going to happen long term in this space, which literally just aligns with pretty much, I feel like, everybody's perspective here in this community now that you guys have kind of seen that we're in a headline driven environment. So take a second here and just listen.
We start hitting sort of mass market product market fit. And it's been pretty easy just to sort of sit back and be patient and have a low time preference. So the answer is, are we having an alt season? I think that's going to be a very contentious thing to say. Obviously, I've been in the camp of beating the drum saying yes, because I think that that's what crypto needs right now is more sort of raw belief, more sort of undying. We don't need any more people saying this is the top, it's all over, blah, blah. There's tons of those voices. I think there's not enough belief that we're at the beginning of a really big cycle of crypto replacing the traditional financial system for the first time with no ceiling on its limit to adoption. Whereas before it was all retail driven, so there was always a ceiling. Now there's no ceiling. We have Wall Street bazooka of money behind Michael Saylor, behind Bitcoin ETF. Now we have Ethereum ETFs and Bitmine and Tom Lee. There's no limit to the amount of money they can access and pull in from traditional markets. So we're going to see a different type of run that might be slower. It might be a slow grind, but I believe that ultimately, this is the process of crypto going mainstream, crypto actually becoming a part of the global financial system. And it's only going to happen once. And I think for that reason, we're looking at probably the biggest cycle that we've ever seen. And who knows how it's going to play out. But when I look out 5-10 years, I see this stuff being worth 10, 100 times more.
If this is going to be more gradual and just part of the process of crypto and blockchains becoming just the infrastructure for finance, does it mean, do you think this could be the last cycle in the way that we've seen them before in kind of there being a huge run up and then like a crash down? Is this different? Like, are we just more like slowly but surely seeing the market cap increase, prices rise? Maybe it'll become more fundamentals driven than like pure hype, or like, do we have something similar where it's like a huge run up and then kind of a correction?
Well, that's the big $10 trillion question, right? Is, do we get a blow off alt season? Do we get fireworks? I think if we start seeing a traditional parabolic run here in October, that would be, if you were just taking the fractals of the prior cycles, then somewhere in October, you'll probably see a top in Bitcoin, and probably within a month, you'll see a top in the altcoins. That would be the traditional cycle. I'm not convinced that that's happening. I'm personally would love to actually see it go the other way, where we see a slower, more agonizing grind up over the next few years. And the actual altcoins that have on-chain revenues, product market fit, all those things really start to get chosen by one by traditional investors on Wall Street. And then you see this maturation and you get this like Mag 7 of DeFi, kind of like we have Tesla and Nvidia and all these traditional stocks that are just crushing it and they dominate. I'd like to see that happen in crypto, where you see this cohort of super elite projects just graduate to being institutional grade. And then at times you'll start to see altcoin overperformance. Now, what I think might happen though, and what I think is the fair way to look at this, is you treat it like it's still a 4-year cycle and you prepare yourself to take profits, but you know that there's a possibility that it won't be like that. And you have to be open spiritually to the fact that we won't see a traditional bear market, that we might see a 30% drawdown and then a bounce back. Like, you know, bear markets in the stock market are like 20%, right? And so maybe that's what a bear market for Bitcoin looks like in the future, where we'll see a 30 to 50% drop and then back up. And maybe it's 3 months instead of, or 6 months instead of, 12 months. Yeah, it's very, very hard to say. But there's definitely a possibility of a recession. We don't know really what's going to happen. But if you start seeing like parabolic explosive altcoin action, usually that is fairly unsustainable in general. So I would expect for that to be a good profit taking moment. But I'd say the fair way to play it is to have one foot in the super cycle narrative and one foot in the traditional 4-year cycle narrative, and make sure you don't leave so much on the table when we're at all-time highs and when alts are exploding upwards and Bitcoin dominance is dropping. Don't leave so much on the table that you're screwed if the music stops, but also be aware that fundamentally the market's changed, and the marginal buyer that's driven us from K to 104K is the institutions, and they have a different way of viewing profit taking and directional momentum and time horizon than the traditional investor. And I think the Bitcoin buyer, the Bitcoin holder,
so there's that gentleman's spiel. And so this aligns with pretty much everything that I've been attempting to show you guys, right? I've gone over my profit taking strategy in this next altcoin season. I've given you guys a basket of assets that I have a substantial amount of that I do plan on taking profit in case we do experience some type of 4-year cyclical event and the market does mirror some previous or past cycles. However, I'm not going to sell my entire bag thinking that I'm going to guess the top, like this gentleman said, in case we're wrong and we don't see some type of cyclical event where we do get a crazy market correction and the market just continues to go up. I don't want to be completely out of crypto. So I've broken those strategies down for you guys in previous videos and Zoom calls. And this just goes to show exactly what I've been trying to show you guys is exactly what an actual creator and protocol builder in this space is aligned with. So it just goes to show that we're fixated our attention on the right things. I feel like a lot of people aren't talking about this, playing both sides of the spectrum, being prepared in case market cycles do mirror previous cycles, but also understanding that the landscape and the fundamental aspect of crypto now is completely changed now with institutions involved. And so another thing he particularly talked about is this correction, right? This correction, the possibility of a correction, 30%, 20% correction in Bitcoin and altcoins or whatever. Well, guess what that's most likely going to be driven by if it does take place? Some type of substantiating risk off market environment, like a liquidity crisis, a complete shift in how the market's pricing in rate cut probabilities as we head into 2026, geopolitical tensions, tariff related headlines, all of these things that we talk about in this community. So I cannot stress enough that now is the time to really pay attention and buckle down and learn these things, right? Tap into these Zoom calls, read the fundamental reports, go about your own personal day and read the fundamentals yourself. What fundamentals do you find that you align with, whether it's moon cycles, technical analysis, or news reports, right? Have some type of approach as to what you think are key drivers of the market sentiment, risk on, risk off. I've been attempting to do my due diligence to show you guys what I think are those things. I've been pretty damn accurate with it up to this point. And I'm going to continue to remain accurate, at least from my perspective, but don't sleep on what type of environment we're headed into and currently trading in now. Okay. So just to go on to that and capitalize on recent market conditions. All right. So zooming out on the higher time frame, I've explained to you guys in previous calls. I know that this is actually, as a matter of fact, let me open up a different chart so that way my drawings on this chart aren't deleted or distracting you guys. So I've been probably one of the only influencers on the internet that's been screaming that the market's been in a bull cycle. We've been in an extended bull market cycle since, 2022. And so exactly what this gentleman is talking about, I'm going to be completely honest with you. I personally think that we're already in that cycle. We're already in this extended bull cycle. And the things that are creating these pullbacks and drawdowns are headlines. So you can see here, and you can't make this up, charts don't lie. We've been going up in terms of price action in the total cryptocurrency market cap since December and November 2022, right? So for anybody to say that we haven't been in a bull cycle, I'm going to be completely honest, is delusional. Now, certain altcoins have not performed well compared to others, but the total cryptocurrency market cap has substantially increased from 7.5 billion, so 750 billion, to over $4 trillion from 2022 until now. And so if we look in terms of these corrections, every single time we get these deep corrections, which happen to be from the top down to the bottom, anywhere between 30 to 40%. This correction from the beginning of 2024 till mid 2024 was 39%. And then the market continued. The correction that we saw from December 18th into mid 2025 was again another 39% correction. And so this is what I personally think is going to continue to happen up until 2030 and beyond, is we are not going to see these substantiating market corrections or crashes anymore, these extended bear cycles that last 1 to 2 years. And instead, we're going to see these corrections that are fundamentally driven because of a shift in the landscape surrounding central bank policy positioning, geopolitical tensions, tariff headlines, all of the things that create risk-off sentiment, or a liquidity crisis. For example, last year, when we had the unwinding of the Japanese yen carry trade, create massive liquidations events and margin carry trade, all these things happen that shifted capital and global assets. That is what's going to create these pullbacks. And people that are uneducated, they're not going to be able to position themselves not only mentally but financially to capitalize on these pullbacks, because they're going to be misled to believe that the market's about to jump into some bear cycle, which I personally don't see. I think that these institutions are the ones that are going to manipulate these prices, and they know what's going to happen under those conditions, and they are going to capitalize on discounts just like they have the last 3 times that these pullbacks have happened. All right. So I'm just going to continue to keep you guys in the loop week by week and day by day with what's happening. So that way you all are aware, you're not fearful, and you can decide to adjust your positions accordingly. So taking a look at the last couple of weeks as we transition into September, what has been going on with price action? You guys can see here, this is a post that I put out publicly on X at the local top, where I mentioned that I wouldn't be surprised if data came out pushing back on rate cut optimism and sent the market into a risk-off environment. And people called me crazy. They said that I was just, I don't even know, like all the crazy comments in the freaking on Twitter that I get all the time, people saying that I'm a lunatic and that I don't know what I'm talking about. Well, the day before that, I noticed that market makers sold slightly early because they were pricing in higher inflation in the CPI and PPI that we were getting in the middle of August. Sure enough, thereafter, Wednesday and that Thursday, we had both higher CPI and PPI readings push back on those rate cut expectations, and the market started to price out high rate cut probabilities in September. Fast forward to where the market recently pumped and everybody got euphoric again, right? This was primarily due to Jerome Powell bringing back rate cut odds on the table with one simple statement. You can see here the crypto fear and greed index popped above the 60 grade threshold. The rebound came after Powell's speech at the annual Jackson Hole Economic Symposium on Friday, where he said that the current conditions in inflation and labor market may, I repeat, may, this is key vocabulary word because people gravitate too much to this and they linger into a greed narrative, may warrant adjusting the Fed's monetary policy stance. Personally, unless we see a massive deterioration in the labor figure on the first week of September and we continue to see lower CPI and PPI prints before the FOMC meeting, I don't think the Fed cuts rates. And if they do, I personally think that they deliver a hawkish cut, meaning they do cut rates in September, but then they push back on rate cuts the remainder of this year by saying that they need to remain data resilient and dependent. And the only way that they cut rates in October and December is if we continue to see lower inflation, right, and deteriorations in the labor market. However, so that was one of the primary reasons for this massively green bullish candlestick here. However, sellers came in and defended. Now, what fundamental drivers were weighing on price over the last consecutive couple of trading sessions? Most people don't know. Why did the market give back all of the gains that we saw after Jerome Powell came in and created an excessively bullish environment where the market was gripping onto those rate cut expectations? Well, just look at the dates and look at the data. So here, when the market recently topped out and corrected itself from last Friday's move, the same exact date that Jerome Powell ushered in those dovish remarks from the Jackson Hole Symposium, literally like 2 hours after that event, President Trump came out and renewed a threat to impose sanctions on Russia. It says here, August 22nd from Reuters, U.S. President Donald Trump renewed a threat to impose sanctions on Russia on Friday if there is no progress towards a peaceful settlement in Ukraine in 2 weeks. 2 weeks, that gives us a significant highlighted date. So that puts us into the first week of September. We need to be mindful of any geopolitical headwinds and these ceasefire announcements or progress. Showing frustration at Moscow a week after his meeting with Russia President Vladimir Putin in Alaska. I'm going to make a decision as to what we do, and it's going to be very important. It's going to be a very important decision, and that's whether or not it's massive sanctions or massive tariffs or both. Or we do nothing and say it's your fight, Trump said. So he gave us not only dates, but he also gave us prospects into what he could possibly say that we know would likely move the market, as Trump has reiterated multiple times on his own freaking True Social account that he moves the markets with his words. Okay. So with that being said, looking at his information here, looking at what he said, if in the first week of September, we do see announcements that the United States is going to move forward with higher tariffs and sanctions on Russia, and geopolitical tensions and tariff-related escalations continue to elevate, what's most likely going to be the scenario, y'all? It's most likely going to put us in a state of a risk-off environment or a consolidation phase where the market does not continue to elevate or experience higher price discovery, right? Because it's going to keep larger investors than you and I in safe haven assets. They're not going to be aggressive towards risk assets because the risk environment is going to be soured. Okay. So I'm just trying to give you guys a perspective into what's next. Inversely, if something positive is announced where sanctions are not imposed, they come to some ceasefire agreement. And then on top of that, they announce that they're not going to heighten tariffs. Well, that's probably going to support risk sentiment, create less demand for safe haven assets, and then we can expect some higher prices or some support in crypto. Okay, so this was August 22nd at the local top. Moving on. In this consolidation phase here, sorry I went down to such a low time frame. Let's go to the hourly. All right, so in this consolidation phase here, this was Saturday over into Sunday, August 24th. And in our report here, when I noticed that market makers were taking profit, everybody was getting a little bit too ahead of themselves in terms of aggressively pricing in rate cuts after Jerome Powell said that they may cut interest rates. Again, key words, may. He didn't say that they are going to. He said they might, right? I noticed this fundamental report weighing on sentiment. And so what I said to you guys in our August 24th report, you can see here at the top, I said, be aware the bearish case scenario would be if geopolitical tariff risks fuel safe haven demand over the weekend. And I said here, the last few months confirm one lesson. Those who use macro-driven pullbacks, $100 to $500 billion corrections to reposition with idle capital are the ones winning. Institutional demand for crypto remains structurally bullish, but macro headlines cannot be ignored. With lingering risks, disciplined repositioning on pullbacks remains the optimal strategy. And then, sure enough, shortly after, as the market opened on Monday, what did we get? Sunday rolling into Monday. You can see here, August 24th, 2025. Russia hits Ukraine with drone strikes as Kyiv celebrates its Independence Day. Well, if we look at the price action on that given day, rolling into Sunday, Monday's price action, we saw a significant drop in price action as the market flipped to risk off and demand for gold and dollar substantially increased, paring back all of the gains from the speculative hype that was driven by Jerome Powell's comments the week before on Friday, right? The market completely gave back all its gains. Following that, on top of the geopolitical uncertainty, we also saw net new tariff announcements that are creating fear, uncertainty, and doubt in global markets, continuing to weigh on risk assets. Trump warned of a 200% increase on Chinese tariffs and exports if exports are not curbed. Right down here, he said, they have to give us magnets. If they don't give us magnets, then we have to charge them 200% tariffs or something. So when Trump comes out saying things like this, it creates risk-off flows And investors tend to take profit in their risk assets, aggressively sell their risk assets, and buy safe haven assets like dollar, yen, or gold, or other safe haven assets that exist out there. Okay. So this was another thing contributing to the recent decline in risk sensitivity. That is why we've seen a recent sell-off in risk assets. We've had geopolitical tension escalations, we've had sanction threats, we've had tariff threats, and all of those things create outflows of risk assets as larger investors reposition into safe havens and again, adjust their portfolios considering the environment. So outside of that, right now, still waiting to see if we can get a drop into the August lows or how the market sentiment continues. If it does continue to worsen, we'll go over the scenarios here in just a second. Let's go over those scenarios right now so that way everybody is prepared and understands the environment moving forward, depending on how the data comes out. All right. So taking a look at this article that I typed up for you guys here, I'll put it in the chat. Long story short, it goes over bullet points on what we need to see in order to see risk assets flip bullish over the next week, heading into the first week of September, and inversely, what could weigh on risk assets and create a more risk-off environment, creating much more pain in the markets temporarily as the markets flip risk off and find more demand in safe haven assets. I'm not going to thoroughly go over each of these bullet points. I've contracted them and made them slightly smaller. So in summary, over the next couple of trading days and heading into the weekend, ideally to see a recovery in risk assets compared to what we've seen in order to see the market find support, consolidate, or trade higher. So that means if we want to see a scenario on the higher time frame on the 4-hour, where after we saw higher inflation up here at these levels, you can see that sellers have showed their hand aggressively multiple times. Buyers have made an attempt to defend at lower prices, but they failed, and sellers came back in at where they previously sold from, trapped buyers at highs, and continued to push price action down. If we want to see buyers overpower sellers, find support, and continue higher, we want to see price action consolidate and not drop lower, or we want to see price action continue up from where we currently stand, then this is what we need to see. We need to see NVIDIA earnings reports come out tomorrow upbeat, signaling strong earnings on NVIDIA's behalf, as NVIDIA's earnings reports have moved markets before and swayed market sentiment, and that data comes out tomorrow after market close. We need to see softer or inline inflation, meaning that we need to see inflation not come out elevated or higher than previous readings or lower than previous readings, both in the core PCE, month over month, and year over year that we're set to get on Friday. We need to see stable GDP that does not push back on the rate cut narrative, meaning the GDP comes out, I believe it's on Thursday, and it does not dampen the prospects or the hopes for further rate cuts this year, not only in September, but also in October and December. We also have multiple Fed speakers scattered throughout the remainder of this week. We would ideally like to see them hold on to the dovish toned narrative, supporting the odds of rate cuts as long as the data supports it. We would like to see lower tariffs announced or tariff tensions ease, coupled with geopolitical tensions de-escalating. No Russia sanctions, ceasefire meetings or agreements announced. And if we can see this environment heading into the weekend and the first week of September, then this is the likely price action that we will get. The market will most likely find some support, maybe even drop a little bit lower to clear out any over-leveraged positions that existed prior to August in the rally that we saw. But the market will likely remain above $3.5 to $3.6 trillion, and we will continue to trail back some of last week's and the week before that's losses. Inversely, if we see NVIDIA's earnings reports come out bad or miss the market expectations, we see hawkish surprises in the PCE figures. That means higher inflation than previous readings or than what the market was expected. We see continued announcements surrounding sanctions, geopolitical tensions, tariff escalations, or any geopolitical headlines that dominate a fear narrative. We see any stronger US data like upbeat GDP figures, healthier labor market data, and the unemployment claims that we're going to get on Thursday as well. Any data that pushes back on Fed rate cut hopes and supports dollar strength from the US is going to most likely continue to weigh on risk assets. So under these conditions, the price action that's most likely going to follow suit is we're going to fail to break above these lower highs. We're going to fail to enter into a market recovery or price discovery. Buyers might make another attempt to break higher. Sellers will likely trap them at highs, and we will likely continue with the overall sentiment to the downside. Or we just consolidate, continue to move sideways from where we're currently trading at without making any new price improvements or higher prices. Or we just continue down from where we currently stand, making our way into and below August lows. Now starting to correct the July move that we saw when the market was again aggressively pricing in rate cut hopes. Outside of that, that's all I have. I'll leave the floor open for open discussion, questions, anything that you guys might have. But for now, that's all I got for you guys.